Okay, so we're going to switch now. I'm going to pull up my whiteboard. I'm going to get in position to talk about Social Security. So this is the last part of the weekly webinar, which we call our Financial 15. So it's about 15 minutes or so. This section is going to be part 4 of a 4-part series called Getting to Zero Tax in Retirement. And this is discussing Social Security, as you can see in front of you. If you're just joining us for this section, what you missed is about 25 minutes of market updates and some analyst reports and some updates from the Ed Slot group, which I think were really great today, as I really actually think they are every week when we read them. But that helps our viewers and our clients learn about pitfalls that they should be paying attention to when it comes to IRA distributions and things that can't be undone, which is most important. It's not an uncommon occurrence that I talked about the class that we're going to be having and starting at the end of September. And it's not an uncommon occurrence where someone will attend the class and they'll learn all these great methods of becoming tax efficient. And they'll say, I got this, I can do this on my own. And they might meet with us and we'll sketch out a really brief kind of idea of how they should move forward. And they'll say, okay, I'm gonna set off on my own and do this. I don't think I need your help, and that's okay. That's fine. That's their choice. And a lot of people come back and they say, "Oh, I didn't see this landmine. I didn't see this pitfall. I wasn't accounting for this." I was just talking to an individual who had some really good intentions, but had a lot of incorrect facts. Folks, I watched a video yesterday of a financial advisor in northern New Jersey who was talking about fixed indexed annuities. And there were about 6 things that were absolutely wrong in that video. So this is really difficult and challenging stuff. And you have to specialize in these areas. You can't, I'm talking from a professional point of view. So I'm not gonna go into that too deeply, but just know that this information is out there for you on our channel now. And it will be available for some time. Again, the plan is to have a second website, Attleboro U, and that will be member-based or just for clients. But for right now, everything's available. So let's talk about Social Security. So I talked about this in the beginning. And again, if you're just joining us on this section, so please hit the subscribe, like, and remind button. That helps us. But and if you're a regular listener to this, share this, please. Share this with other people, and you can share when you get your invitation for the online webinar coming up for the Changing World of Retirement Planning. You can share that as well. You know, we don't have restrictions on classroom space, so we're all good with that. So Social Security can be taxed. Folks under 50, folks in their mid 50s. Again, this isn't even on their radar thinking, what? Part of my Social Security can be subject to tax. What you're going to learn today is up to 85% of your Social Security can be subject to tax. Not taxed at 85%. People hear that 85% and they think, whoa, wait a minute, 85% of my Social Security is going to go back to the government. It might feel that way, but that's not how it works. I'm going to tell you how it works. So the amount taxed depends on this calculation called provisional income. People say, well, what's it based on? Is it based on taxable income? Is it based on modified adjusted gross income? Adjusted gross income? What's it based on? It's based on none of those things. It's based on a separate calculation the IRS has called provisional income. Provisional income is the income that the IRS tracks to determine how much of your Social Security is going to be taxed, period. And there are some separate calculations for that. So let's talk about what counts as provisional income. Well, any earned income you have counts as provisional income. So now, again, this is assuming that you're collecting Social Security and you're trying to determine how much of your Social Security is subject to tax. And I should have snapshotted on here, but there's a schedule that's in the 1040. I don't know the form number off the top of my head, but there's a schedule that helps you calculate how much of your Social Security is subject to provisional income. So any earned income, any pension income you receive counts as provisional income. Any rental income, if you have any rental properties at all, it's going to count towards provisional income. 1099s from the taxable bucket. Remember, folks, you've got your funds that sit in different buckets. Taxable, tax deferred, and tax advantaged or tax free. So we're talking about in the taxable bucket, I don't want to go back to the beginning here, but remember, these are typically your mutual funds. You might have some stocks in here. You might have some bonds in here, CDs, savings accounts, money markets, all of that, right? It can, of course, be in the tax deferred bucket, but the tax deferred buckets are IRAs, traditional IRAs. So traditional IRAs, 401ks, etc., retirement plans, things like that. Things that you're promised to pay tax for on later, you don't pay tax on it now. But back to the taxable bucket, these are things that you get taxed on every year. You get it 1099 that's issued from the federal government. You get it for interest, dividends, capital gains, long-term gains, short-term gains. And interest can be significant. Our money market account right now is pulling close to 5%. So that could be significant. Short-term bonds and, the government bonds are, I think the 90-day treasury is at about 5.28. I think that can be significant. So, it can produce some significant income if you have too much money in this taxable bucket. And we're going to talk about that. But that's what we're talking about the 1099s from the taxable bucket. Well, distributions from the traditional IRAs from the tax deferred bucket. So any distributions from traditional IRAs, whether they're required minimum distributions or just regular distributions you want to take. See, I'm blocking it a little bit with my face. Any distributions from the traditional IRAs and 401ks, etc. Anything that comes out of that tax deferred bucket is counted towards provisional income. This surprises many. I'll make this a little larger so you can see it. Interest from municipal bonds also counts as provisional income. But interest from tax-free, right? Tax-free, air quotes. You see me doing air quotes? Municipal bonds. So they add that allegedly tax-free income in to that provisional income calculation. And then they add back in 1/2 of your Social Security, just to kind of put salt in the wound. So that all counts as provisional income. So what does that all mean? Follow me over here to the left. These are the current provisional income brackets. And these provisional income brackets haven't changed since I've been focused on tax efficient planning since at least 2012. If anybody knows that this has been updated since 2012, let me know. But as far as I have seen, or I can remember, they have not been updated. And so what that means is that your tax brackets, your marginal tax rates, capital gains rate, things like that, we see them increase every year with inflation numbers, just like your Social Security does. And, there's certain things that are indexed to inflation, which means there's a calculation and they go up every year. So if the income levels and your marginal tax rates go up every year, that means you're paying, more consistent or maybe less tax as your income rises, right? Because your income rate is adjusted up. The top of the 24% bracket right now, for instance, is about $364,000 for a married couple. Last year, I want to say it was about $320,000. So that's what I mean. Anything, you're able to capture more income in that tax bracket this year because of the increase in inflation. The problem with provisional income is that these numbers haven't moved. So let's focus on married filing joint. So if you're married filing joint and you have under $32,000 of provisional income, if all those things that I just talked about add up to, including 1/2 of your Social Security, add up to under $32,000, well, you don't pay any tax on your Social Security. If from $32,000 to $44,000 in provisional income, you pay up to 50%. Remember, there's a schedule to figure out how much that is exactly, but you pay up to 50% of your Social Security is then subject to tax. Let me say that over again because it sounded a little confusing the way I said it the first time. Up to 50% of your Social Security benefit would then be subject to tax. And I'm going to show you the breakdown of that in a minute. Anything above, again, married filing joint, anything above $44,000 in provisional income, up to 85% of your Social Security benefit is then subject to tax. And of course, if you're a single filer, and we're going to talk about this as well, it's a little worse. So you got to be under $25,000 in provisional income to have none of your tax or Social Security subject to tax. You got to anywhere between 25,000 and 34,000, up to 50% of your Social Security benefit is going to be subject to tax, and above 34,000, up to 85% of your Social Security benefit is going to be subject to tax. So what does that mean? It just simply means if let's keep it easy. Actually, let's use the numbers here. So you'll see here you got an income gap. So if your Social Security is at $55,000, that means you're about up to 85% of your Social Security is going to be subject to tax. So let's just assume that's the case. So $46,750. So you got to take 85%, $46,750. Let's make sure I'm not drawing on my, yeah, okay. We're going to make this a little smaller so I can see my own calculations and not block anything. Okay. So $46,750 flows into your tax calculation, just like you earned it. So let's just say it comes down to about here, this $46,750, and lands about here. And let's say that gives you an effective tax rate of about 20%. Now, why isn't it 22%? We've talked about this before, but I'll tell you again, your first several dollars. Well, I'll tell you what it is. If you give me a moment. This is the tax chart that you can get from our website. If you go to the slot corner, you can scroll down and get this. And let me just clean this up for us a little bit so we can see what we're talking about. Okay. So you can see here, we flip it upside down because it flows better for discussion. But from zero, the married couple, from $0 to $22,000, you pay 10% in tax. From $22,000 to $89,450, you pay 12% in tax. And then you from $89,451 to $190,750, you pay 22%. And it keeps going up like that. So it's not as though some people say, it's going to put me in another tax bracket. It doesn't include all your income. It's a gradual process. So as I just explained to you, the income flows in, and now $46,750 flows into here. And in this example, it lands here. So it's the effective rate, the way I just explained it to you, is a 20% tax. So follow along back up here. I'm back up here on the right-hand side. So now if this $4,000 or $46,000 of that $55,000 Social Security benefit you may have is subject to tax, you multiply that by the 20% tax rate. That means $9,350 has to go right back to the federal government in the form of tax. So they give you $55,000 in Social Security benefits, but you got to send back $9,350. So you might say, okay, well, that's not too bad. I don't know anybody who really says that, but let's just say you do. And you say, okay, that's not too bad. I'm giving up $9,350. Well, the problem is that most people plan on using their Social Security benefit during retirement. Don't you? Yes, I hear you say yes. Yes, of course you plan on using your Social Security benefit during retirement. And you plan on using that $9,350. That's your money that you've planned on, and you might have worked with your financial planner. And I have to tell you, folks, I coach financial planners all around the country, and I hear from folks who work with other financial planners from all around the country, and they're not having this conversation about the amount of money they could potentially lose for their lifetime income, because Social Security is an annuity. It's a guaranteed lifetime income that's coming from the federal government. And suddenly you're planning on $55,000 and $9,350 is ripped out from under you. And it, of course, is worse than that, because most people have most of their money in traditional IRAs, traditional retirement plans and whatnot. And when they're planning on using that $9,350, where do they take that income gap from, that shortfall? This is what we call the income gap. So now there's a big gap in their income. I think $9,350 a year is a pretty big income gap. You can take a nice vacation. You can do whatever you want with that, except now you got to give it back to the federal government. So what do? You take that money out of your IRA because that's where most of your money is, right? But it's not that easy, is it? Because you've got to take more than the $9,350 out of your IRA to actually get $9,350 because you have to pay tax on that money. So the math says at a 20% tax rate, you actually have to take $11,687.50 to net out a spendable. So let's not, we not use fancy words like net out, things like that, but a spendable $9,350 will cost you $11,687.50. And then, of course, it doesn't stop there because, as I told you, Social Security increases with inflation every year. Sometimes it's small. Sometimes it's super big like it was last year. So every year your Social Security goes up. Your tax, provisional income doesn't change. I just told you I haven't seen a change in this since 2012. So the provisional income, the tax amount on your Social Security gets greater, or you trigger different brackets, or God forbid, one of you passes away and now you're a single filer instead of married filing, jointly file, and more of your Social Security is subject to tax. And the tax rate is higher. So you have to take more and more money out of your IRA. And of course, then you have opportunity cost. The more money you take out of your IRA, the less it stays in there and is able to grow. And that's where this really gets big, this compound number. So a simple $9,350 distribution to cover tax or less amount in your coming to you in Social Security can mean hundreds of thousands of dollars, literally hundreds of thousands of dollars over your lifetime that it's costing you because of that. So what's the answer? How do you manage this? Well, you got to ask yourself first, what is not counted as provisional income?